The largest financial market in the world and a key player in the world economy is the foreign exchange or FX market. Trillions of dollars are converted from one currency to another every day. This form of cash exchange is necessary for global trade. Governments, companies, and of course, investors are among those that participate in the Forex market. Governments carry out policies through the FX market. For instance, a nation needs to convert its currency into a foreign currency when doing business with another nation, whether it is borrowing money, lending money, or providing aid. The currency market is used by businesses to streamline global trade. For instance, they could have to translate payments for goods and services purchased abroad, or convert payments from international clients into the currency of their choice. Additionally, traders that engage in currency speculation use the Forex market. Since the foreign exchange market is open consistently from Sunday at 4 p.m. to Friday at 4 p.m. Central Time, currency prices vary practically continually during the week. A trade day begins at 4 p.m. Central Time and finishes at 4 p.m. the next day. Due to the worldwide character of the economy, the market must be open continuously. Let's review the fundamentals of how FX trading operates. Trading Forex involves trading two currencies against one another, not just one thing. An example of a currency pair is this. The value of one currency in relation to another is specified by the quote for a Forex currency pair. Any quote can be understood most easily by reading the pair from left to right. Let's use the euro and the US dollar as an example of a currency pair. If the EUR-USD exchange rate is 1.20, 1 euro is worth 1.20 US dollars. Here's another illustration on how to use the US dollar and Canadian dollar as a currency pair. 1 US dollar is equivalent to 1.25 Canadian dollars if the USD-CAD exchange rate is 1.25. Despite the fact that there are two currencies involved, the pair functions as a single unit. It's comparable to stocks or commodities. Investors gain when they purchase a currency pair and its price rises, exactly like when trading stocks. Investors can also make money if they short a currency pair or sell it and the price drops. Let's examine a case in point. Imagine a trader who predicts that the euro would acquire strength against the US dollar because she believes that Europe's economy will expand more quickly than the US. To speculate on her theory, she can purchase the pair of the euro and the US dollar. She will profit if the value of the currency pair increases. On the other hand, she will suffer a loss if the price drops. After going over the fundamentals, let's examine a few important features of the currency market. You simply need to put up a portion of the total investment when trading on margin in order to open a position. The margin requirement is the name given to this sum. When you trade other securities such as stocks, you are borrowing money from your broker since you are trading on margin. However, an investor's Forex account must be funded in order to cover any Forex trades. To engage in a currency transaction, investors cannot borrow money. Before making a trade, individuals must put money into their Forex account if it's empty. Let me know in the comments if you have any other questions about investing. Let's return to the video. The size of a deal and the currency pairs affect the Forex margin needs. Typically, trading in currency pairs takes place in units called lots. Standard and small lots are the most prevalent lot sizes. Mini lots are 10,000 units in size, while standard lots are 100,000 units. You might also be able to trade Forex in 1,000 unit increments or micro lots, depending on your brokerage company. Although margin requirements can change from 2% of a trade to 20% of a trade, they typically fall between 3 and 5% for the majority of currency pairs. Let's look at an illustration utilizing the euro and US dollar as a comparison to illustrate how margin is determined. Imagine if an investor wished to purchase a normal lot, or 100,000 units, of this pair at its current price of 1.20. The trade would cost $120,000 in total. That much money is a lot. The investor need not, however, cover the entire sum. Instead, she makes the required margin payment. Let's assume that the required margin was 3%. 3% of $120 is $3,600. The investor requires that much in her currency account to execute this trade. This brings up leverage, another crucial component of the currency market. By using a relatively little quantity of capital, investors can use leverage to control a sizable investment. In this case, $3,600 gives the investor power over $120,000. One of the largest advantages of the Forex market, but also one of the biggest risks, is the leverage connected to currency pairs. Investors that use leverage stand to gain or lose a lot of money. Financing is another crucial component of the currency industry. When an investor holds a position after the end of the trading day, the net interest earned or due on currency pairs is calculated. The cost of borrowing money is determined by an overnight lending rate tied to the US dollar that is set by the Fed. Every foreign currency also has a unique overnight loan rate. Always keep in mind that you are trading two currencies against each other when you trade currency pairs. You are theoretically long one currency and short the other, even if the currency pair behaves as though it were a single entity. You lend the currency you are long and borrow the currency you are short when it comes to financing. The overnight lending rate of each individual currency is used for these lending and borrowing transactions. A credit is typically given to an investor when his long position is in a currency with a greater interest rate than his short position. When the currency an investor is long has a lower interest rate than the currency he is short, the investor is debited. Let's examine a case in point. Consider an investor who is long the Australian dollar relative to the US dollar. Consider that the overnight loan rates for the US dollar are 1% and the Australian dollar is 2%. The investor holds long positions in both currencies, holding long positions in AUD and short positions in USD. The investor will be given a credit because the AUD has a greater interest rate than the USD. The investor would have to pay the debit if he was short the AUD-USD currency pair, since he is short the currency with a higher interest rate. Your brokerage firm automatically handles financing. It's crucial to comprehend its operation and the financial implications for the industry. Nevertheless, only a few components of the Forex market have been covered. The first step to deciding if the Forex market is the perfect chance for you is to educate yourself about the dangers and rewards that come with it, as with any investment choices. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.